chapter 14 to 16, we concentrated on the capital. So we concentrate on we learned about the cost of capital in chapter 14, and we learned about how to raise capital in 15, and in the chapter 16, just few seconds ago, we learned about the capital structure. And now that's the one part, and now we are going to learn about a different aspect of the financial management, which is about the payout policy. So let's say there is a company and you are running the company as the manager and you are doing good. So you have enough finance, you have enough capital. So you invested in some projects and you did well and your results are good. Then what you should decide is the payout. How to redistribute your wealth with your shareholders. So in chapter 16, we are going to learn about the last process of your cycle in business, how to give returns to your shareholders. So in chapter 16, basically we are going to learn about the dividends, whether you should give more dividends or not. And actually, there are two different ways that you can compensate your shareholders. The first one is the dividend, and the second one is the stock repurchases. So therefore, in the third section, we are going to compare between the dividends and the stock repurchases. And the logics for the first and the second section, these are the same as the previous chapter. So theoretically, dividend policy does not matter. So we are going to learn about the irrelevance in the dividend policy, and then we are going to discuss some of the real world factors that affect the decisions about the dividends. And finally, at the end of the chapter, we are going to learn about the stock dividends. And it is confusing, this term, stock dividends. This is confusing because it looks like this is a dividend. However, this is not the dividend. So we are going to learn about their effect on the shareholders' wealth at the end of the chapter. So I think maybe we can have some time to talk about the irrelevance today. So let's begin. So before we move on, let's talk about the dividends themselves. So dividends are the cash payments made out of the firm. And to understand the dividends, let's compare between the stock and versus the bond. So as you already know, the stock is the equity capital. So when you issue new shares of the stock, this will constitute your equity. On the other hand, if you issue new bonds or notes, then this will be your debt. So basically, the essence of the bond is to borrow from the investors. However, the investors, when they buy the stock or the shares, it means they are participate in the business. So if you have shares of a company, then you are at the same time you are the owner of the company. However, if you purchase the bond, then you are not the owners. However, you are the creditors. So you are providing the liabilities, and eventually the company needs to pay you back. And for the compensation for the stock and the bond, in the case of the bonds, we have interest. So this is a borrowing and lending. Therefore, the lenders can get some compensation, and these will be the interest expenses from the point of view of the company's financial statements. On the other hand, the compensation given to the shareholders will be called the dividends, and this is not the expenses. So in the income statement, we start from the sales or the revenues, and we extract certain operating cost, and we have EBIT, which is earnings before interest and taxes, and we deduct interest expenses, and we get the taxable income, and we pay the taxes, and at the end we get the net income. So as you can see, the interest given to the bondholders are here. So this is before the calculation of the taxes. So as we learned, we can have the interest tax shield effect. So by having more bond, our tax payments to the government decreases. So this is a side effect which is good for us, for the company. On the other hand, the dividends are not expenses, therefore it is not directly shown in this income statement. However, among the net income, some of them will be distributed as the dividends. So let's say if you have $100 net income, then maybe the company can choose to have 20 as the dividends. So this is the after calculating all the expenses and the taxes. So whether you increase dividends or not, it does not affect the corporate taxes that the company needs to pay. However, the remaining part of the net income that are not distributed as the dividends will go to the retained earning. So the retained earning is the retained earning. So therefore, this is for the future. So if the company chooses to give everything they have as the dividends, then nothing will left. So there is no future. However, if the company believes that there could be more growth for the company, then maybe company can choose to withhold the net income and stop dividends, and they invest the money for the future. So by doing so, they can give more better return in the future for their shareholders. So we have two different choices, dividends or retained earnings. And let's say the shareholders get the dividends. So this is given to the shareholders. Then you should also understand that there is again the taxation. So from the point of view of these shareholders, they are earning the dividends. So the government will charge the taxes to these shareholders. So the dividends will be taxed. So there is a dividend tax in Korea as well as other countries. So from the point of view of the shareholders, it seems like they are paying the taxes twice. when first their companies are taxed in terms of the corporate taxes, and then later when they distribute the money, again their returns are taxed in terms of the individual dividend taxes. So it seems like they are paying double taxes. So this will affect the decision making process of the companies when they choose about their dividends. Okay, so these are the dividends are fundamentally different from the interest expenses of the bonds, and therefore we should be careful when they decide about the dividends. And generally, in reality, the companies pay dividends 4 times in a year. So for every 3 months, they pay the dividends if they want to do so. And let me tell you about the procedure or the process when the companies give the dividends to their shareholders. So dividends are important corporate decision, so it should be approved by the board of the directors. So first, the CEO of the company propose a plan to have the dividends for their shareholders. Then this matter will be decided by the board of directors, and the board of directors will vote for these dividends, and they are going to decide whether they are going to have dividends or not. And if they approve the payment of the dividends, then they declare or they announce the dividends, and the declaration date is the announcement date. So they say, publicly state that we are going to pay the dividends today or this year. And they, at that moment, they also specify when the money will come. So when is the dividend date? So this is the date of payment. So this is the date that the actual investors get the dividends as promised. And there are other 2 dates. So let me talk about these 2. So maybe during the midterm period, your students' council decided to give you some snacks for the students because you are preparing for the midterm exams, and it is very this is very hard time, so maybe you need some good thing to drink and to eat while you are studying. And they announced that, hey, we are going to give you some burgers or sandwiches, so everyone comes here and get the food for the preparation, and you are going to go there and stay in a line. However, there could be some problems. Some students are cheating, so they get the food and the drinks once, and they go back to the lines and they wait again to get another food. And that could be very problematic in terms of the management as a student council. So to avoid that, maybe you are going to have some procedure like writing your name or making a signature there and checking the student ID or something. So the similar thing happens for the shareholders. So when the company announces that we are going to have dividends, then maybe some shareholders are trying to get double dividends. Or maybe some shareholders are missed out, so they didn't get what they should have get. So to avoid these kind of process, these kind of mistakes, the company needs to make a list of the shareholders from shareholder number 1 to shareholder 100, 1000, the last one. So the making the list is the date of record. So this is the date when the company make a memory about the current member of the shareholders from A to Z. And based on the list, they are going to give the dividends as promised. So they are going to record the name and number of shares each one has, and the address, and the account number, bank, blah blah blah. So all the information should be recorded, and this should be prepared before the actual date of payment. So this is the date of record. However, then another problem arises. So now the membership, the shareholders will be recorded on this day, and there will be difference if you have already the shares before the date of record, or if you purchase the shares after the date of record. So if you purchase the shares, so we have the date. So we have the date of record here. And so let me use this example. So here in this example, the declaration date is the date that the board of directors announced that they are going to have the dividends, and they say the actual dividends will be given to the shareholders on February 16, after 1 month. However, to make sure that every shareholders get the dividends, they predefine the record date as the January 30, which is 2 weeks ago, right? So there should be some investors who purchase the shares before the January 30, or some shareholders who purchase after January 30. So if you purchase the shares before January 30, so maybe if you purchase the shares on January 29, then actually buying the shares, you get not only the share, but also you have the right to get dividend. But on the other hand, if you purchase the share after the record, say January 30, then by purchasing the share, you only get the share, but you do not get the dividend. So there is a striking difference based on your timing. So if you purchase the shares before this recording, you get the dividends, but after the dividends, immediately you lose the right to get the dividends. So therefore, the investors will realize it, so they highly value this right. So therefore, the stock price changes. So they want, here is this is the record date, and then before the record date, the stock price is at this level, but just after the record date, the stock prices decline. So there is a drop in the stock price. So this drop is called ex-dividend, because this is about whether you get the dividend or not. So that's why we have another important date, which is January 29. So if you are going to if you aim to get the dividends from the company, you should buy the shares no later than January 29. So that's the meaning of the ex-dividend date. However, if you purchase the shares after the ex-dividend, in other words, from the record date, your name is not on the list, so you cannot get the dividends from the company. So therefore, the stock prices are going down. Right, so that was about the dividends in general. So I have some time. So let me explain about the dividends. So let's say now as a corporate manager, you are going to decide about the dividend policy. It means you are going to make a decision about whether you pay more or not. And actually, as I said, paying dividends is about whether you are going to have more dividends or whether you are going to retain more of your earnings. So by giving dividends means you are going to compensate your shareholders immediately today. However, if you say you don't want dividend today, it means you are going to retain your earnings. It means you are not going to compensate immediately. It means you are going to compensate your shareholders maybe in the future. So this is about timing issue. By choosing dividends, it means you are compensating for the shareholders right now, but by choosing more retained earnings, it means you are going to wait for the future, because in the future, you can be better. You can provide more to your shareholders. So this is about timing, whether you are going to pay right now or later. And theoretically, there is no difference between giving dividends right now or in the future. There is a famous Chinese and Korean saying about the situation. So I'm not sure about how to say in English, but we have 3 in morning and 4 in the dinner. So 3 in breakfast. So in Korean, 조삼모사. So this is exactly the right saying about the dividend policy. So for the international students, let me just briefly explain about the background of this. So once in ancient China, there was a very high noble, and he was carrying his monkeys, and monkeys were claiming, so usually he gave 3 corns to each monkey every day in the morning, and he also gave 4 other corns for their monkeys. However, the monkeys claim that they need more because they are hungry, so the noble changed the policy. So from now on, you are going to get 4 in the morning and you are going to get 3 in the dinner. So that was the change policy, and every monkey was so happy so that they can get more in the morning. However, actually, there is no difference. So this wisdom says that if it does not matter whether you get something early or later, and this is also true for the dividend policy. Whether you get more right now or whether you get later, it does not matter at all. So let me explain why this is possible. So suppose there is a company named Wharton. So to make it simplified, let's assume that there is no debt. So it is a 100% equity firm, and there are 1,000 shares outstanding, and one important assumption is that it will not continue forever. So there is no going concern. So it will only operate for the next 2 years. One year, 2 year, and it's gone. And each year, the company generates a cash flow of $10,000. And the case number 1 is that the company will distribute everything they have for the first year. That means they are going to give $10,000 as the total dividends, and because the number of share is 1,000, for each share the dividend is $10. So each shareholder will get $10 in the first year, and same as the first year, in the second year the shareholder will get another $10. So if this is the case, and if there is no future operation, then these two $10 are everything, all that the shareholders can get from the share. So therefore, it will determine the stock price. So the $10 in the first year and another $10 in the second year, the present value of these two cash flows will be the stock price. And by calculating, you get $17 as the stock price today. And because the company has no debt, the market value of the company itself will become the company's value, and it will be 17,360. However, let's think about the same company but with different dividend policy. So in this second case, now it decides to have 50% dividend ratio, and then it means among the $10,000 that the company generates in the first year, 50% will be given as the dividend. So $5,000 is distributed. So therefore, what the shareholders get is $5 in the first year. And another 50% of the money will be retained. And it will be distributed in the second year. And therefore, because the retained earnings will also provide some return, let's say it is 10%, then the cash flows in total has been increased from 10,000 to 15,000. And therefore, what the shareholders get at the end of the second year is $15.5, which is this, $15,500 divided by the number of shares, which is 1,000. So each shareholders will get $15.50. And then in that case, we can again calculate the stock price based on the present value of the two cash flows, 5 and 15.5, and surprisingly we get 17.36, which is, there is no difference between the previous case and this case. So the stock price does not change. So when we compare the first case and the second case, we can see that in the first case, they are going to have the same amount of dividends for the first year and the second year. However, they emphasize more in the future, but there is actually no change. And we can even think about the third case, which is having 110%. So, in this case, we again have the same company. However, now they are planning to give more when compared to what they have already in the first year. So they try to give $11 per share to the shareholders. And as you can see, they only have $10,000, so they need extra $1,000. And therefore, they should borrow it from the bank. So they borrow $1,000 from the bank, and they need to pay certain interest for the future. So therefore, in the second year, their cash flows decrease as much as what they should pay back to the bank. So in the second year, they only have $8,900. So therefore, what they can give in the second year is reduced to $8.9. And if we calculate the stock price based on these two cash flows, again, shockingly, we get the $17.36 as the stock price. So whatever dividend we choose, we can see that we always we get the same stock price and we get the same firm value. So the dividend payout ratio itself does not affect the firm value. So therefore, you should not care about the dividend. You don't have to care about it because everyone will get the same results. So that's the implication that we can have in this example.